Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things you need to know today.
First up, U.S. stock futures in the green this morning as the S&P 500 nears an all-time high. The benchmark stock index closing above the key 6,000 level in Friday's trading session, just 2% away from a new record. Investors seeking catalysts to continue to drive stock gains and Wall Street seeming hopeful. Morgan Stanley's Mike Wilson sees strong earnings supporting stocks, while Goldman Sachs points to a resilient economy to help drive equity gains.
Plus, the other big catalyst for investors, U.S. trade talks with China here. Representatives from the world's two largest economies meeting today in London, following a call between President Trump and President Xi Jinping. The talks aim to resolve issues such as rare earth exports, tariffs, and restrictions on advanced technology. The talks come after both China and the U.S. accused each other of violating a temporary trade truce.
And we have Apple's Worldwide Developers Conference kicking off today in Cupertino, California. Investors will closely watch for Apple's artificial intelligence strategy. Wall Street skeptical of the company's advances. Kicking off at 1 p.m. Eastern Time, the keynote address is expected to introduce redesigned software interfaces for the iPhone, iPad, Mac, Apple TV, and Apple Watch, in addition to more minor tweaks to the Vision Pro headset. It's according to Bloomberg's Mark Gurman.
U.S. stock futures are higher right now, holding on to some slight gains this morning across the Dow, the S&P 500, and the NASDAQ. Trade talks between U.S. officials and Chinese officials are underway in London as the two nations look to build on a truce brokered back in May. The talks were announced last week after a long-anticipated phone call between President Trump and China's Xi Jinping. U.S. Treasury Secretary Scott Bessent and the Commerce Secretary Howard Lutnick and Trade Representative Jameson Greer will meet with Chinese officials in the Monday meeting. China's exports of rare earth minerals are expected to take center stage at the London meeting. Earlier this month, the two nations brokered a deal to drastically roll back tariffs, but China's control over the rare materials and current limits on China's access to U.S. semiconductors emerged as sticking points. The meeting expected to extend into the evening and possibly last through Tuesday, according to Bloomberg.
Well, trade talks between the U.S. and China are one catalyst that could power U.S. stocks to new highs, with the S&P looking for its next driver after closing out above 6,000. So what are the catalysts investors should be watching this week? Joining us now with more, Yahoo Finance markets correspondent Josh Schaefer. Josh, great to have you on this morning. Talk to us about what investors should be looking for this week, especially off the back of some price target lifts that we're getting as well.
Yeah, Maddie, so you have, of course, just from an economic data standpoint, you have that inflation report coming out later this week, consumer price index. You also have the producer price index. So essentially, inflation reports for the month of May will be out this week, and that will sort of set the stage for what we're expecting from the Fed's preferred inflation gauge later this month, but it gives you a good sense of where things are headed. Economists actually expect inflation to have ticked up a little bit in May as tariffs start to weigh on some of those goods prices. But I think another interesting one is going to be released later today at 11 a.m. You have the New York Fed expectations, right, coming out from the New York Federal Reserve, and you also have Michigan's consumer sentiment survey at the end of the week. And this is because you guys were just talking about Goldman Sachs coming out, continuing to be bullish on stocks here. They highlight an interesting chart detailing the difference between soft economic data, which would be those surveys I just mentioned, hard economic data, which would be something like that inflation release. Here's the chart you're looking at now, right? So hard data is that long line that comes down significantly. But what's interesting within this chart, soft data in green, again, those surveys, that usually falls first when we are talking about an event-driven recession. That would be something like the 1970s oil shock, 1970s interest rate shock, those types of things, the dot-com bubble. That's the base case scenarios that they were sort of looking back on using for this study. And what happens is you normally have soft data start to trough soon. It will bottom first. And what we saw earlier this month, or I guess it was really in May, consumer confidence has started to come back up, right? Does the University of Michigan sentiment survey on Friday also start to come back up? Have the vibes gotten so bad that the vibes are starting to get a little bit better, essentially, is the question. And that would normally be when you start to see stocks recover, as they have, and then data will maybe get worse from here. Maybe there's more worse jobs reports out there, maybe a couple more worse inflation reports out there, but the market would have already priced that in, and normally you would have seen a bottom in stocks.
But if the data even was to worsen, it seems like the market's taking more of its cues from what the tariff talks are around versus how imminently we will get some type of massive Fed movement to cut rates.
I think to some extent, Brad, but I think the market seems to be sick of tariff talks and maybe more interested in tariff action, right? I mean, you look at S&P 500 futures today up minimally, right? We're showing them on the screen. They're up slightly, but generally speaking, the U.S. meeting with China is not really moving the needle that much for the market at this point, it doesn't seem. With us, of course, back near record highs, right? We've moved the needle plenty.
Sure.
We've had a very big rally, but I think a lot of strategists are arguing that you would have to have a significant deal, like an actual deal, something signed, real things. And I don't know if that's necessarily coming. So it seems like, at least for now, tariffs and sort of the back and forth is taking a little bit of a backseat to what the data is actually doing. Because remember, we're now starting to get May data, right? That jobs report was from May. That means the tariffs were in effect. We're starting to see what those tariffs are actually doing to the economy and getting some of those answers we've been waiting for about 2 months now.
And it makes me wonder, too, about this idea of the market grinding higher, even on perhaps lower breadth as well. We had Citi talking about they are marginally more constructive. That doesn't sound that bullish to me. Marginally, maybe more constructive.
Yeah, so Citi moved up their S&P 500 target to 6,300 today, right? I think it was from 5,800. 6,300 is only a 5% rally through the end of the year, right? So Scott Kroner highlighting in that note that they still think things are going to be bumpy. To Brad's point about trade policy uncertainty, we're not done with that conversation, right? What he said, though, is he thinks the bottom might be in. So rather than chase a rally, right, if we keep rallying higher, they'd be buyers of dips. And so that's how they're thinking about sort of this range that we're in right now. Kroner also pointing out within that note, you're starting to see GDP forecasts come back up, right? Those estimates tanked in April, and those are starting to come back up. So how much do those come back up, and how much does this AI story take hold? That would make Kroner incrementally more bullish if AI continues to lead the story here, and we keep talking about the big AI names and sort of that tech trade growth.
Yeah, FactSet saying that more than 40% of S&P 500 companies have cited AI on earnings calls for the fifth straight quarter here.
You still got to talk about it, Brad.
You still got to. Yeah, you got to. Yeah, it's the name dropping, basically.
Yeah.
We got to say we're doing something right. Josh, thanks. Well, President Trump told NBC News this weekend that he had no desire to repair his relationship with Tesla CEO Elon Musk after the two exchanged heated blows on social media last week. Two Wall Street firms downgraded shares of the EV maker Monday after the stock fell more than 14% in the past week. Our next guest is a longtime Tesla bear with a sell rating and a $170 price target on the stock. Ron Yosiko, Guggenheim Securities Automotive Equity Research Director, joins us now. Ron, good to see you here with us this morning. So, I mean, just take us into first your thinking as the spat was playing out via social media and Twitter fingers essentially were prevailing. But how much of this is an overhang to Tesla as an operation and as a manufacturer of vehicles?
Yeah, it's a good question, and thanks for having me. I would say our basis for the stock has had very little to do with politics since Trump was elected or before Trump was elected. But the stock has clearly been sensitive to political headlines. The stock rallied almost 100% post-election on this view that Trump would help deregulate autonomous vehicles and kind of clear a path for Tesla's robo-taxi plans. We always thought that was a bit dubious. I think that states and local municipalities were always going to have a role to play in autonomous regulation. They do today and they will in the future. But there was clearly a bid in the stock on Tesla being tethered to Trump, and we saw a lot of that unwind last week. For us, it doesn't change anything. We have not ascribed any value to any kind of political outcomes here, but it is certainly creating a lot of noise in the stock.
So what are those fundamental drivers, Ron, that you would want investors to perhaps refocus on to have good investor hygiene with regards to this name?
Yeah, it's a good question. I mean, for us, we focus quite a bit on the vehicle business, the energy business, and the potential robo-taxi business. I think there's no denying that the robo-taxi opportunity is a large opportunity. We just think it's much further into the future than I think the stock implies. And in the meantime, the energy business is a nice growth driver, but it's nowhere near large enough to justify the current valuation. And the auto business is deteriorating to the point where I'm not sure it's free cash flow positive this year. And data through May looks increasingly weak. There's been no acceleration on the new Model Y. So I think the fundamental drivers of the business as it sits today continue to skew negative. And then the robo-taxi launch, we'll see how it goes. But I think the major question for us is when it goes from the planned 10 cars in Austin this month to something much larger and more generalized when this can actually go to multiple states. I know Tesla has pretty ambitious targets. I would say we're generally skeptical.
Ron, you have a couple more firms this morning that have hopped into the bear den as well. You've got Argus downgrading to a hold from buy for Tesla shares. Baird also downgrading Tesla to neutral from outperform. Price target $320 here. And the analysts there saying that essentially the excitement over the upcoming affordable car and robo-taxi launch in June, they think that the 24% rise despite a weak quarter versus the S&P 500 13% rise is partly due to that. When you talk about what another mass market affordable car could mean for Tesla, what is the realistic timing that you're baking into your modeling on that?
Yeah, I mean, we're still working under the assumptions that Tesla reiterated last quarter, which is a launch at some point in the second quarter. That's for production, not for deliveries, but we're expecting to see something this month. In terms of what we're baking into our model, we do expect it to be margin dilutive. We don't expect it to contribute a ton to net volumes because we think ultimately it's going to cannibalize the Model 3 to some degree. This is, at the end of the day, you are taking the lowest marginal buyer and probably shifting them to this more affordable model. It probably helps a little bit in China, but ultimately they really have no prospects of competing in the large growth buckets of China, which are under 150,000 RMB. And this vehicle, I would be very surprised if the upcoming new models are priced that low in China. I think it's mixed negative at the end of the day, marginally positive for growth.
Yeah, you mentioned China. How much do you think it moves the needle in China, knowing that BYD and some of the other homegrown manufacturers have really started to eat into Tesla share and actually out-deliver?
Yeah, BYD is about a third of the electric vehicle market in China. Tesla's sub 10%. So it's more than eating into the share. Almost all of the growth in China for electric vehicles has come in the under 150,000 RMB price point. Think of that $20,000 US and under. Tesla doesn't have a product there. We don't think they will have a product there. And candidly, competing with BYD is going to be really tough because BYD is more vertically integrated than Tesla in China because they own their battery IP. Which is a key differentiator and helps them drive down cost. So I don't see a world where they are able to really grow market share in China ever.
Well, let's talk about one area they are at least hoping to gain market share in, which is via the robo-taxi launch, still remaining on track for June, coming up here this week even. Talk to me about the degree to which you see that as a potential growth area for the stock going forward.
Yeah, it's a great question. I think the robo-taxi is clearly the single biggest positive or negative catalyst over the next 6 to 12 months. Our view is this is going to take quite a bit longer than what we think the stock implies, which we think is basically a full commercialization strategy in the next couple of years. But at the end of the day, the robo-taxi is clearly what has gotten investors excited about the stock. I think eventually Tesla has to prove that their generalized approach to autonomy, having the fleet and things like that, can leapfrog existing robotaxi and ride-sharing platforms. We think that that's going to be a very tall task over the next 12 to 18 months. And if that doesn't happen and autonomous expectations are pushed to the right, this is going to be a very tough stock, I think, to own on the long side.
Ron, really appreciate you joining us. Thank you.
Thanks for having me.
More than 50 people were arrested in Los Angeles over the weekend after President Trump deployed the National Guard in response to a string of immigration raids in the city. Law enforcement used tear gas, rubber bullets, and flashbangs to control the crowd as demonstrators blocked off a major freeway and threw objects at police. Alphabet's Waymo suspended service in the city after at least 5 of its autonomous cars were set on fire during protests. That's according to the New York Times. And a shocking video, an Australian journalist was struck by a non-lethal round while covering the protests. 9 News confirmed that the reporter was okay. Separately, a British photographer needed surgery after being shot with a sponge bullet. California Governor Gavin Newsom and LA Mayor Karen Bass condemned the Trump administration's decision to deploy 2,000 members of the National Guard over the weekend. Newsom said the state will sue the administration over that deployment. President Trump on Sunday mentioned the possibility of sending in the Marines, stressing the need for, quote, law and order.
Well, we're going to have troops everywhere. We're not going to let this happen to our country. We're not going to let our country be torn apart. If we see danger to our country and to our citizens, we'll be very, very strong in terms of law and order. It's about law and order.
We're going to have more coverage ahead on Morning Brief. Stick around.
Now time for some of today's trending tickers. We are watching Qualcomm, Nvidia, and Joby Aviation. First up, let's go to Qualcomm here. Agreeing to buy semiconductor company Alphawave for $2.4 billion. The London-listed company designs semiconductor tech for data centers, networking, and storage. And the deal is expected to be completed in the first quarter of 2026. There you're taking a look at shares of Qualcomm actually responding well to this. Typically, you see the company making the acquisition, actually moving lower. But in the case where investors might say, hey, they got a pretty good deal, and how accretive it might be to the business and the opportunity for scaling that business being acquired, investors might be cheering this one on just a little bit here, as evidenced through the pre-market action here.
Yeah, it's a fascinating markup for Alphawave. I believe it's a 96% markup from where the stock closed on Friday here. Also, for shareholders of Alphawave, they will have the option to convert those shares to Qualcomm shares. And a reminder, adding to what Brad was saying, Alphawave does specialize in kind of that high-speed connectivity technology. So that is going to enable Qualcomm to be able to have access to data that can travel faster for less power, which perhaps is why the stock is up, because that lesser power would also potentially protect their margins going forward in the future. Next up, let's talk NVIDIA. CEO Jensen Huang praising the UK's artificial intelligence sector, calling it a, quote, Goldilocks circumstance. Huang going on to say that it's an incredible place to invest while speaking at London Tech Week. This comes as the chipmaker announces several partnerships in the UK, and also comes as President Trump and Xi Jinping are in London having those trade talks today. Really interesting to see these tech CEOs picking other countries outside of the US to cozy up to amid the back and forth on tariff policy.
Yeah, it's a little bit of making sure that you're also speaking kindly of some of the officials, elected officials, and even in the case of when they made the visits to the Middle East, some of the crown princes and other dignitaries there, making sure that you're staying away from any negative type of light, especially knowing that you're going to be trying to pop up data centers everywhere, essentially. And so for NVIDIA, looking at and praising the UK, especially with who they were speaking on this panel with, British Prime Minister Keir Starmer, and then as well the Investment Minister, Poppy Gustafsson, and talking about machine learning and where NVIDIA potentially plays a role as it's really intending to show its globalization efforts at this juncture. Another key opportunity for Jensen Huang to become even more internationally known than he already is, and developing some of these partnerships as well with the UK this time.
Absolutely.
And finally here, let's go to the air, to the skies. Air mobility stocks climbing after President Trump signed an executive order aimed at boosting U.S. drone manufacturing. Now, the order establishes a pilot program for electrical vertical takeoff and landing aircrafts, those eVTOLs. Now, the administration says that the program will allow companies that are already conducting this type of testing to partner with state, local, and tribal governments. You're taking a look at shares of two of the more well-known eVTOL companies, Joby and Archer Aviation, both moving higher here. Archer up by about 12% here pre-market.
You want to hear something crazy about Archer? It's up 208% over the last year, which is crazy. Joby is up 60% in the last year, and both are up year to date despite some of the stock market volatility. So certainly seeing some of that bullishness around these eVTOLs getting any type of FAA regulatory approval playing out in the stock prices here. You also have Toyota backing the likes of Joby, and then you've got both companies looking to the Middle East as potential profit drivers going forward as well. So certainly a slew of catalysts for those names, especially Archer there with those moves to the upside. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Meantime, Apple's Worldwide Developers Conference kicking off today in Cupertino, California. The iPhone maker expected to focus on design and productivity enhancements for its operating systems. Joining us now, we've got Bob O'Donnell. He is Technalysis Research's president. Bob, great to have you on this morning to get a sense of what we can expect this week. What are your expectations?
Thanks, Maddie. Great to be here. So look, I mean, basic news is everybody believes is going to happen is a lot of sizzle and not necessarily a lot of steak. So we're going to see new UI designs for iOS, macOS, watchOS, iPadOS, tvOS, Vision Pro OS, every OS they have. They will all have a new consistent look that is apparently supposed to be similar to what the Vision Pro has. And then they're going to have a new numbering scheme. They're going to line up with the calendar years. We've seen other companies do this. So instead of iOS 19, it's going to be iOS 26 because it's going to come out late 25 and mostly be available in 26. That's the plan. Then we'll see some other enhancements expected, but basically everybody thinks that all the previews suggest very little on Apple Intelligence and Siri. And of course, that's where all the market buzz is. Everybody has been talking about AI. You guys have been talking about it for the last few minutes. I've been listening. I mean, that's what everything's about. So there's definitely going to be some disappointment, I think, from the hardcore AI folks and some of the hardcore Apple fans. But, look, the thing with Apple, they have this incredible knack for having the right timing on a lot of stuff. So my question really is, hey, so they're late, but in the end, will it really matter? Because not everybody's out there using AI all the time. A lot of people are just sort of nibbling at it. And by the time Apple gets their act together, hopefully they'll have, the demand will be there and it'll all just line up.
And we've talked at length about generative AI almost replacing the initial mindset to begin a search query on one of the more popular search engines over the past few decades here. What is the technology that you anticipate really driving that next kind of thrust point forward for how people are activating generative AI through the devices that they're using?
It's a great question, Brad. I mean, it boils down to agents, right? Agents is where we expect to see AI move from being just a chatbot, typing in a prompt kind of a thing, like a search query or what have you, into actually performing actions. And so that's where you've got AI essentially running in the background, doing all these things. And for the record, at WWDC last year, Apple presented this very cool vision of exactly that. Like in a way, they were a little bit ahead of the curve on the whole agent story. The problem is they haven't been able to deliver on it. And the few things that they did put out did not work well. The basic text summarization and notification summaries, all these things did not work at all like they were expected. The other challenge for Apple, of course, is they don't have their own LLM. They're using other people's. They're partnering with a number of folks. And of course, there's a big question of, do they really need to have their own? You would think down the road at some point they probably do. So I don't know, maybe they'll tease that today. We'll see.
Is there anything that Apple could say this week that would change not only your mind, but Wall Street's mind on where they stand within the AI race? Like, how high is the bar for them?
Well, I mean, look, the bar is super high. Nobody else has more devices in the world, so no one can have a bigger impact on how people integrate AI into their everyday experiences than Apple, right? I mean, it's 1.2 billion or however many devices they're up to these days. So the bar is incredibly high, Maddie, but they have got to show that they're able to deliver on some of the vision, like I said, that they showed last year, that they're making progress on doing some of their own models, that they, have a sense of how they're going to get things there. And frankly, even integrate, like, how do I think about Siri versus Apple Intelligence? How do they work together? Is Apple Intelligence behind the scenes and Siri's in the front? Even clarifying some basic things like that, I think are going to be important because there's a lot of confusion about what Apple's trying to do. And then, of course, partnerships. So originally, there was a thought they would have an announcement with Google to leverage Gemini in addition to OpenAI. But now it sounds like perhaps that may not happen. We'll see. That would make a difference as well if we saw some big partnerships with some other LLM providers.
Is it likely that none of these kind of announcements will drive a raging supercycle for Apple, especially as it relates to the major product, which makes up roughly half of their revenue, the iPhone?
Yeah, look, Brad, the only thing that's going to drive a major super cycle for the iPhone is a new iPhone design, right? I mean, we've all been using the same iPhone design for the last, 7, 8 years, whatever, right? And there's been a lot of talk. I've been a huge fan of foldable phones, originally with Samsung, the Google Pixel Fold. I've been using a bunch. People are going to love a foldable iPhone when Apple finally gets there. And so that is, to me, the thing that's going to drive the next super cycle. The software stuff is great, but you combine that with a new physical form factor that looks and feels different, that's when we'll see it. And I don't think that's going to be this fall, probably next fall.
Bob, good to see you here this morning. We're going to be watching closely for what they announce at WWDC. Thank you.
Thanks, guys.
All your markets action ahead. Stay tuned. You're watching Morning Brief.
That is your opening bell on Wall Street, taking a look at the New York Stock Exchange and the NASDAQ. But let's do a check on the markets here, because congratulations to the S&P 500 crossing above that key 6,000 level on Friday. The big question, now that we're a little over 2% away from a new all-time high, what's going to get us there? Taking a look at the S&P, it is up today. I'm going to give you a longer dated view just so that you can see the wild ride that we have been on, because let me zoom out to, obviously we had all of the tariff uncertainty, that post-Liberation Day low here, and then you've got stocks continuing to move to the upside. I also want to mention that we are up year to date finally as well. So again, that key question, will we continue to be able to drive out those gains? We had some strategists coming out with new calls on their S&P 500 targets this morning, and they say things like, we'll maintain moves to the upside, but it's kind of a complacent vibe. It's not necessarily one rooted in a lot of bullishness. You got your NASDAQ and your Dow Jones moving to the upside this morning as well. Taking a look here finally at treasuries, yields are continuing to move to the upside, and the dollar still under pressure. You've got the dollar down over 9% year to date. Brad?
It's time now for today's strategy session. The bond market under pressure following the latest jobs report, which showed strength in the labor market, shifting investor expectations for rate cuts this year. The moves come ahead of an auction this week for 30-year bonds that will test demand for long-dated treasuries. Joining us now, we've got Michael Gousset, who is the Principal Asset Management Chief Investment Officer of Global Fixed Income here. Michael, good to see you once again, and thanks for joining this morning. First, as you're thinking about what this auction could really spell out about where investors have appetite for duration, what are your anticipations?
Yeah, good morning. Thanks for having me. Certainly the auction, as you noted, is one that's going to bring a lot of questions into where is the demand at this point. The long end of the curve traditionally is a place where pension plans, insurance companies tend to really dominate the flows. More recently, as rates have been higher, you've seen foreign investor demands really create some successful auctions for the Treasury. With some uncertainty about how tariffs are playing out and how the U.S.'s role in world order continues to unfold, there is some concern that we could see some auctions not gaining enough demand in order to meet what the Treasury needs to bring to the market.
How likely do you think that is, Michael?
So I think it's probably overstated, but the term premium still isn't significant enough to really attract investor demand into the long end of the curve. And you do have the uncertainty about how tariffs will result in inflationary pressures, how that affects the Fed is all stuff that is creating uncertainty, and uncertainty pushes investors to stay at home. And at this point, we think that there still is enough demand, there still is attractive enough yield levels from a historical perspective for investors to participate in these auctions and to be buyers of the bond market. But there is enough uncertainty out there that the future could be a little different.
As we continue to monitor how the Fed's reaction could come forward, we've got, of course, this mid-June meeting that's really going to take kind of center stage in terms of how the tone for the rest of the year, for the back half of the year, where we're anticipating about 50 basis points of cuts, could influence some of the investor sentiment. So is it likely that investors would wait until that meeting to participate in later auctions once they get a sense of how the Fed is perhaps moving towards those cuts?
Potentially. I think the Fed is, in a little bit of a tricky spot right now, and you've heard that from a lot of different members of the Fed governors on how they're going to react to what is likely to be some pickup in inflation related to tariffs, what is likely to be a slowing economy, but not necessarily a recessionary type economic conditions. And so I do think investors are looking towards the Fed, as you noted, 50 basis points of cuts this year, as giving some guidance to what the total return of the asset class could look like for the rest of the year. But if you're just looking at it from a yield-based buyer, an income-based buyer, these are attractive entry points for fixed income investors.
They may be attractive entry points for those investors, but it seems like investors are wanting more, that they're starting to get to a place where they're demanding more yield for the risk of owning U.S. Treasuries. Would you agree with that? And what do you think that does to the yield curve if that's true for the rest of the year?
No, that's exactly right. And I think that's where the pressure on the long end of the curve will continue as investors are demanding higher term premium to lend the U.S. government money out past 10 years. Inside of 10 years, very dependent on economic conditions, inflation, and as you noted, how the Fed does react to economic data. But for yield buyers, the slope of the yield curve probably isn't enough yet to incentivize those investors to be pushing out to the long end of the curve.
You know, I wonder from your own evaluation, the one big, beautiful bill, as the administration is calling it, and the anticipations that it would add trillions of dollars to the country's already $36 trillion debt load over the next decade here. To what extent are bonds being influenced by the passage and the discussions and negotiations moving forward around that?
Yeah, the markets don't like uncertainty. That doesn't matter if it's the equity market or the fixed income market. I think we're getting to understand what this administration is trying to achieve through the tariff programs, through the big, beautiful budget bill, and the implications that'll have for taxes and in deregulation. And so ultimately, as there's some more clarity coming into the market, you're seeing stocks go back to all-time highs and bond yields catching a bid anytime you get any kind of sell-off. So, the uncertainty is continuing. I'm sure we're not through it yet, but the budget bill and the anticipation of that much increase in debt will ultimately long-term affect the U.S. ability to be able to issue debt to the same degree that we have from a historical perspective.
So to that point, how much of any moves off the tax bill eventually getting passed would you say are related to deficit concerns long-term more so than any near-term policy concerns?
I think it's probably limited, to be quite frank. The concerns about the deficit are always going to be there. They've been there for years. This isn't our first year of running deficits or increasing the amount of debt outstanding. So that's continually to be pushed back into a concern for another day. And investors are going to be focused on what are the inflation data prints, what does the job market look like, what does that mean for Federal Reserve policy, and less so about how does the U.S. debt burden continue to grow.
Michael, thank you so much. Appreciate your time this morning.
Thank you.
Let's get to the three market movers you need to watch for the trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Well, thank you, Maddie. We got Russell 2000 and the S&P 600. Those are the small cap indices finally perking up here. We also have some big U.S. auctions on deck this week. We're going to talk about the $120 billion in long-term debt that's going to be auctioned, as well as crypto. Bitcoin making its way to 107, almost 108,000. So let's start at the beginning here with small caps on the Wi-Fi Interactive. And I'm looking at the S&P 600. And I'm going to pull up a 3-day chart so you can see the breakout was actually Friday morning. That's what I'm circling there in green, but we are at higher highs today. And if I put a year-to-date chart on, you can see if you squint real hard, we have an inverse head and shoulders formation here, and we are just kind of peaking above that. And it's not a really strong breakout just yet, but I guess we have high hopes for these things. Anyway, crypto has really been kind of the laggard of the group, and so it'd be nice to see this kind of catch up just in terms of seeing broad equity participation. And along those lines, I'm noticing some strength in the industrial sector, specifically some of its industries like aerospace and defense have been extremely strong. This is a year-to-date chart of XLI. That's the large cap industrial ETF from Spider, and that just broke to a record high on Friday. It's been hitting record highs recently, and it was one of the leaders after this big consolidation that we had in the majors and a lot of other indices for about 3 weeks. Also got to highlight ARK Innovation Fund because that had a nice breakout on Friday, and I think that was welcome for investors. There's that consolidation in green that I was just talking about. So many of the indices and ETFs were going through that. So ARK is a leader, and really interesting to see the break to new highs, not only in the large caps, but in some of the smaller caps. And ARK Innovation Fund mainly composed of some of those smaller caps, notwithstanding Tesla. And let's take a look at some of the big U.S. auctions on debt this week. We got the 30-year on Thursday, but before that, tomorrow, Tuesday, we got the 3-year, and on Wednesday, we got the 10-year. You put them all together, it's over $120 billion in long-term debt. And when there has been some hiccups in the auctions in prior weeks, that has kind of spooked equities on a temporary basis. So a lot of traders are going to be paying attention to that this week, especially as some rates overseas in Switzerland, they're going negative right now. So if you can believe that, the 5-year has gone negative in Switzerland after a hiatus for several years there. So that's the 30-year. Just want to show you the 10-year. Oh, by the way, the 30-year nearing 5%, and the 10-year is over 4.5%. So these are just some big psychological numbers that traders have been reacting to. But here's the ICE B of A Move Index, and what this is, it's kind of like a VIX for the bond market. And so the fact that we are at multi-month lows right here bodes very well for the bond market and also for risk markets. Risk markets do not like a lot of volatility in anything, but especially the bond market. So that is a plus there. Also, got to tell you real quick, the US dollar index still hovering near 3-year lows. I'm going to wrap up on crypto, and it was nice to see Bitcoin breaking to the upside here. This is what happened today. And let me just show you the 3-day chart so we can take a look over the weekend. Definitely trending up there. And I think the year-to-date chart really speaks volumes, because I was worried a little bit about the potential for a false break to the upside because we're back below that breakout level. But now it looks like we are reversing once again. So that would actually be a false breakdown. And could there be another fake out? Maybe, but that's not my base case. I think we take out those record highs now, just given the strength of this pattern and the fact there's some short covering in here. Maybe we need a new catalyst to get to material new highs, but I think it's an easy case to get to 110, 112,000. Also got to show you Ethereum real quickly. That remains in a trading range, despite the fact that it's up today, jumping a little bit. It is just locked in a trading range going back about 4 weeks. So the rest of crypto hasn't been that strong over the last month, and that's why I'm not too excited about racing to new highs, but probably just get a nice pop and test it and see what's going on around 112, and we'll find a new catalyst from there, maybe. Back to you, Brett.
Jared, thanks so much. Setting up today's trading activity. Coming up, U.S. and China meeting for trade talks today in London. What to expect from the negotiations?
U.S. and Chinese officials, including Commerce Secretary Howard Lutnick, Treasury Secretary Scott Bessent, and U.S. Trade Rep Jameson Greer are in London Monday for trade negotiations as both nations work to reach a deal while hefty reciprocal tariffs are paused. National Economic Council Director Kevin Hassett telling CBS he's, quote, very comfortable with the prospect of the U.S. and China reaching a deal. Wendy Schiller, Brown University professor of political science, joins us now for more. Wendy, great to speak with you this morning. Talk to me about what the main objective is today. It seems like the focus is more on sector-specific tariffs and export controls versus any large baseline tariff number.
The main objective is to get a deal that does not disrupt the supply chain for really important and what we call rare minerals, or sort of materials that we have come to rely on China for things that we ourselves rely on in our daily lives, like our cell phones, among other things. And so, the tariffs that we're putting on China, and then, of course, China's response, which is to deny us potentially access to the things that we need, particularly manufacturers, that's a really dangerous combination with the Trump administration, because prices will go up and then there'll be sort of blocks or, scarcity in the supply chain. And, COVID was now almost 5 years ago, more than 5 years ago, but people remember not being able to get things. They remember having to pay more for things. And those supply chain effects lasted well after people sort of got out of lockdown in COVID. So the Trump administration has a very delicate balance now between its tariff policy, its stated goals of returning manufacturing to the United States, but making sure that the supply chain and the flow of goods stays consistent in this period of time.
And so once the deal is netted out, what does policing follow-through look like of some of the purchase agreements?
Well, that's the big question mark. It seems as though the Trump administration is not cutting jobs in the U.S. Trade Representative's office or the Department of Commerce or the Department of Treasury, where you're going to have people who really, particularly export-import control, our export-import bank, these are really crucial federal employees that will be monitoring the flow, monitoring whether we still have access to China's markets, monitoring how this is all going for U.S. businesses. And you need those employees. So, if you're watching DOGE, you're watching these cuts to the budget, I think that's where we're going to have to make sure that federal employees who know what they're doing here still have their jobs.
Well, and even regardless of that, too, there's questions about whether or not both sides from a leadership perspective are actually going to stick to the agreement. It seems like there were questions about that coming off of the last agreement, both sides kind of accusing each other of not following the rules set forth by the agreement. To what extent are you concerned about that going forward?
Well, just from a snapshot perspective, it seems as that, China really has very strong leverage in this particular area because of the value of the commodity that we rely on. And so they want to use that to leverage the tariffs that Trump has put on lots of other things from China, where we may not be as dependent on that, where we can absorb, at least the Trump administration is saying, we can absorb the additional costs on those goods coming in from China. Consumers will still buy them and businesses can still survive. So this is where China, this particular today, what they're talking about, they have the leverage here because it's a commodity that we really want and need. But in the other trade negotiations, the Trump administration is trying to figure out how far they can go to push China to open markets, reduce all sorts of things, in property theft, intellectual property theft, the kinds of things we've been complaining about since the first Trump administration. That's where the U.S. thinks it has an advantage. But for today, China seems to be more in the driver's seat.
Wendy, I think it's been remarkable as well to see the spate of CEOs, the handful of them that have made multiple trips, knowing where trade representatives from the U.S. are going to negotiate, whether that be in the president's Middle East trip or whether that be the fact that Jensen Huang is also in London right now. How much say or influence do you suspect that some of the corporate America profiles and CEOs also have in these negotiations that are taking place?
Well, there's certainly the direct consumer, right? They're purchasing these materials from China. We saw with the China trade, the tariffs, right? Where Trump went really big, but then, Tim Cook might or might not have made a phone call, and then he exempted particular parts for cell phones or mobile phones. So, you can see where some of these CEOs have influence with Trump, and then some of them as consumers may have influence that helps the United States in its bargaining with other countries. But that, again, is a delicate dance, because any given day, Trump can wake up and say, why aren't you making these things in the United States? Why don't we try to find more of these minerals and access here, if it's at all possible? The point is, you don't know how the president's going to react on a daily basis. So for corporate America, you want to be in the room, you want to stay on the phone call, but how much influence do you have in making this administration more consistent in both its trade and its export-import policies?
And I'm also curious, we've seen shipment data from China indicating that it's continued to trend down regardless of the pause in any of those more severe tariffs on Chinese imports. What do you make of that, given that we are in the middle of that lowered tariff rate with China?
Well, again, this is also sort of playing to the U.S. consumer. If China does this, and particular small businesses or larger businesses, whether it's actual goods that are being imported or materials that we use to manufacture goods here, then that creates a little more scarcity. That means that prices go up. That means consumers are unhappy, maybe pull back on spending. And there's a sort of consumer reaction that translates into political reaction, which means that the House GOP or the Senate GOP might say to the president, look, we're starting to see people really pull back. We may be creating a recession or the fear of a recession with these policies. Can we do something about that to reassure the consumer and keep those prices from increasing?
Wendy, great to have you here with us today. Thank you so much for breaking this down.
Thanks for having me.
Coming up, Warner Brothers Discovery out with a big announcement. The company will split into two by next year. We'll dive into the details after the break. Shares of Warner Brothers Discovery rising after announcing it will split into two public companies, one that includes movie properties and streaming service, and another that includes news and sports divisions, among other businesses. Here with the details, we've got Yahoo Finance senior reporter Ali Canal. Ali, what do we know?
Hi, guys. Well, there was hints around this, right? We knew that the company was restructuring. They wanted to separate the streaming studio side from the network side. We've seen similar moves from other legacy players like Comcast, which will spin off most of its cable properties later this year. Disney has even toyed with the idea, and although CEO Bob Iger has since walked back a lot of those comments, a lot on Wall Street think that that's an area that the company could continue to explore. But for Warner Brothers Discovery specifically, what's so striking about this is that this combined company was formed a little over 3 years ago. It has a ton of debt. It actually took on a lot more debt in the process of that combination. And nowhere in this announcement did we really hear much about the declines that we've seen overall for the network side of the business and the television side of the business. So I'm curious how this is going to play out in the public markets here and what shareholders are really going to look at when they're evaluating these two separate businesses. Clearly, investors are liking it right now. Shares are up as much as around 12% earlier today. I'm seeing shares up just around 10% at this point. The transaction is expected to close by mid-2026. It seems like on the network side, at least, they're going to continue to lean in on sports. There is that symbiotic relationship between the network side along with the streaming side. But overall here, the early commentary on Wall Street sort of shows how this company has been fumbling through a lot of the disruption that we've seen across the industry here. So a lot to be determined. Again, writing was on the wall when it comes to Warner Brothers Discovery, when it comes to a lot of the other legacy players out there. Just how the market receives this, though, I think is going to be an interesting tell sign on the future of this sector.
And do we know anything about what the leadership is going to look like at these two companies, or anything else about kind of what that executive presence might be?
Yeah, so Warner Brothers Discovery CEO, he is going to lead the streaming and studio side of the business, and then the CFO, he is going to become the new CEO of the network side of the business. So both of those leaders will remain at their current post until the separation, and then we will see that official leadership change there. So still keeping it within the same orbit.
Yeah.
Of course, we know with how these things go, things could change very, very quickly, but it's expected by mid-2026, we're going to see that official separation.
All right, well, we'll continue to talk about it with you, Ali, as we have been for several years, it feels like now. Thank you so much for joining us. Appreciate it. That's going to do it for the morning brief this morning. You can join me in the next hour for more analysis on Catalyst and Bradford Wealth after that. Stick around.